Because sometimes I look at my Amazon cart and then the prices drop up and down. I was like, wow, I missed a good sale. I can't imagine your portfolio, you drop 20%, then you're like, wow, I got to hold it in.
Okay, when my portfolio dropped 20% in 2022, do I feel the pain? Of course I feel the pain.
I mean, it's heartening to know that even you felt it.
Of course I felt the pain. Who don't feel the pain, right? And if you look at the world today, honestly, are we going back to the globalization that we have seen in the last 10 years? I think the world is very polarized. There's a lot of populism everywhere. I think it's very difficult for the world to go back to where it was previously. If you follow the news quite closely and you think that gold is your insurance, make sure you buy the right insurance. You may have bought the insurance, but the insurance may not work when you need it most.
What's up, everybody? Welcome to another episode of Yala, your thrice weekly podcast where we talk about the hottest news with a touch of what, Terence?
Good old humor.
Good old humor, man.
Yeah.
Today's a interesting episode about, a topic that's always on everyone's minds.
Yeah, and you know, someone who's clearly very, very rooted in Singapore, based in Singapore.
Had a long career in the area of finance and the markets, the financial markets. So without further ado, we'd like to welcome Joo Wah, who is the Chief Executive Officer of Lion Global Investors.
Thank you.
Welcome.
It's my pleasure to be here.
Yeah.
Welcome.
Lion Global Investors.
Yeah.
Sounds very ambitious, very tenacious, right? And tell us what you do as the CEO of Lion Global Investors.
Okay, so basically Lion Global Investors is the asset management arm of the OCBC Group, right? So under the OCBC Group, we have Great Eastern Insurance. And as a result of the backing that we have from Great Eastern, actually our, what we call in financial jargon, AUM, asset under management, is actually relatively big. We have about 78 billion of AUM. We help investors to so-called realize their dreams, to help them to plan for retirement. And to me, managing money is a very serious business. Okay, the objective is not just simply to make money. At the end of the day, what your clients are looking for you is to help them in their retirement planning. And what I always tell my managers is that it's very important that we take this, it's not just a job, it's a passion. That whatever savings that they have in their retirement age, during the retirement part of the life cycle, you want to ensure that they have a good retirement life.
So I think, that's a refreshing perspective, because at the end of the day, a good retirement life, ultimately you need the finances, but it feels like you're looking at it from a quality of life first, and then how we can enable that through finance, as opposed to the other way around. You earn this much so you can have a good life. Am I right to say that?
Okay, when you talk about quality of life during your retirement stage, there are a few things, right?
Yeah.
You must have your own hobbies, you must have a few other things. But fundamental to that, you must have a certain amount of money to give you, enable you to live the life that you want. All right. So my job, I make sure, is that we ensure that our investors, hopefully through our work, we can help them to realize that basic amount that they can have for their retirement. So that's how I look at it.
I mean, it is quite in a sense, quite a noble mission to help people achieve their dreams. When you look back in your own past, and you connect the dots and all, what pushed you in this direction of wanting to help people achieve their dreams?
Okay, I'm not going to tell you that, from young I have this passion. Okay, that's not true. It's a very simple thing, right? When I was in secondary school, we studied science, and then you always think you want to be an engineer. Then when we start doing practical experiments, and then I look at my friends and me, we do the same thing in the test tube, but for whatever reasons, I have a different answers from them. And my answer is usually not the correct answer. So that was when I realized that actually maybe engineering is not my core in life. So when I went to JC, I took economics. And that was when I realized that actually I like economics. And it's also something that I have an innate interest. I like to read about business. I read about what is happening to the economy. And it's also something that I can do well. All right. So naturally, after JC, then I went on to take a business degree. So I won't say it's something that from young I have this passion. It's something that I realized in JC that it's something that I'm good at, something that I'm interested in.
Yeah.
Now, in the early part of my career, the honest truth is that you're just trying to do your job well. You're going to trying to beat the market and so forth. But it's only at the later stage of my life cycle, when I became a chief investment officer and the last 3 years as a CEO, that you start to think about broader issues, right? That is your job simply just to manage money for people, trying to beat the market? Yeah. Is that all that you are trying to do? So, and at that point, I was just discussing with my predecessor, the previous CEO, and we say we want to do something to help Singaporeans for their retirement. And I think one aspect about some of these things that you all have been reading about markets is that, funds don't outperform the market. My own thinking is that it's actually not that fund managers are bad. It's actually sometimes the fee level is a little bit too high. And therefore, as a result, the fund managers, they are able to do well, better than the market slightly, but may not be able to cover the fees. Our intention at that point in time was that we say, why not we come up with a low-fee alternative for people? Okay, I'm not saying we are charity, we will still make money, but we are willing to make lesser money. But at the end of the day, it's actually good for both investors as well as good for us.
And that was with regards to LGI or something new?
That is regard to LGI. So we came out with this low-cost multi-asset fund about middle of 2018. That's about 7.5 years ago, where we only charge a management fee of 25 basis points for a multi-asset fund. Now, I think if you look around the market, there are very few of such low fees. Usually, they are maybe 75 basis points or so we charge about 25 basis points. But having said that, the timing of our launch actually wasn't very good. We launched it in the second half of 2018. And the market came off immediately after we launched. So it was down about 5-10%, depending on which fund you buy, whether it's a higher risk or a lower risk. But if you are able to ride through the cycle, so from middle of 2018 to today, on an annualized basis, the higher risk fund is up about 7.6 annualized return. All right. And the lower risk one is actually up about 4.8. So to me, again, this reinforced my views about how people should invest. You must invest with a longer view cycle. If they have actually on the first day invested and half a year later they are down 5-10% and they got panicked and they have got out, they would have missed through these whole returns. I mean, 7.7% annualized return is pretty good, right? I mean, you look at your CPR rate is about 2.5. So to me, 7.5 is actually very good.
But that shift that you mentioned about the mission to create something low cost for Singaporeans, did that kind of epiphany come from just those discussions, or even for you personally? What changed as you became CIO and then CEO? Like what internally made you think that about the broader picture?
Okay, when you're younger, you are just simply trying to do your job, right? I mean, you don't have actually a say in the overall direction of the company. So you are given a certain portfolio, you manage it, and you try to beat the market. But when you go up and you be a CIO or the CEO, you can say, I can afford to take a bigger picture view. All right. And then we realized that actually retirement planning is something, honestly, in Singapore, I think a lot of people actually haven't really started really thinking very much about that. Sometimes people look at investment and then they say, can I make 10-15% of it? They don't look at a retirement planning as constructing a portfolio that is for the next 20-30 years. And we also realized that if you compound all these fees over 20-30 years, actually it pretty much into your returns. Especially if you're on the low risk portfolio, right? Where if it's largely bonds, and how much can bonds return give you? So we wanted to create something where we say it's good for Singaporean, and also the product that the way we design the product, we feel is suitable for Singapore investors. And I think maybe here I would like to draw a distinction, right? You see, if you are a foreign house, for example, they will create product that they can be sold everywhere else, in Europe, in other parts of Asia. But for us, when we create a product, we want to create a product that is for Singapore liabilities. You retire, unless you want to go Thailand or you want to go Taiwan and retire, your liability is going to be in Sing dollar, right? Because your spending power is going to be in Sing dollar. So we want to make sure that the product we design is actually to so-called protect your purchasing power in Sing dollar terms. Whereas for the international house, they can't be catering to every single market. Their single product, their multi-asset is sold globally. So then they tend to take a slightly different view from us. So just simplistically, right? We always feel that the bonds part of your portfolio, a larger part should be in Sing dollar bonds. Whereas if you're a global house, why would you do Sing dollar bonds? They will do what we call global bonds. But is global bonds suitable for a Singapore investors? My answer is no, right? Because if Singapore inflation is high, interest rate is high, then you can get the higher returns from your bonds. But global countries, US, Europe, their economic cycle can be different from yours. You could be having low inflation, they could be having high inflation, you could be having high inflation, they're having low inflation, and their interest rate cycle will be very different. But for diversification, yes, you will still need some global bond exposure, but you shouldn't be 100% in global bonds. But if you are a global house and you're selling your product globally, it doesn't make sense to put some Sing bonds into it. And how do you explain to your European investors? How do you explain to your Thai or Malaysian investors? So we felt the way we create a product that is actually tailored more to a Sing dollar based investor.
Whereas because the global house will be in other dollar denominations.
They tend to be more US dollar denomination.
So then you lose on the exchange rates.
I mean, you and I know, right? When I graduate, I still remember now Sing dollar to US dollar is maybe 127. I don't know whether you're old enough as me. It was more than $2 the last time, right? And the other one is, of course, the British pounds.
Went from 3, I think when I was in my early 20s, it was £1 to 3 Singapore dollars.
Correct.
That was, I think, probably the peak.
Hey, you look much younger than that. Are you sure that was... that was many years back when it was more than $3.
That was 2008.
Right. When we were studying the US, I remember US dollar was 1.7 or something like that.
But thank you. I accept the compliment.
But I mean, other than about the dollar denomination also, what is unique about Singapore, our environment as a safe, very safe place, and people see it as a hub where people can come and go very safely. Does that also affect how you think about how investors should shape their portfolio in terms of risk and all as well?
Okay, I think you may have heard recently that we came out with this fiscal gold fund. And actually that is part of the idea that we have about the changing global landscape and what does it mean. Okay, so to me, there are two implications to that. In the old days, when you talk about saving for retirement, it's always about bonds and equities, right? When you talk about high risk, low risk, it's a question of how many percentage you have in bonds, how many percent you have in equities.
And equities would be like stocks and all.
Stocks and all this, right? But I think the thinking in the last 2-3 years have actually changed somewhat. That equities and bonds may not just be the only two assets that you need for retirement. That as part of your retirement planning, you should have some fiscal asset, and that actually include gold. And I think if you look at the last 2-3 weeks or months or so, a lot of people are coming to the idea that as what we call strategic asset allocation, SAA, for your retirement, you should have equities, you should have bonds, you should have gold. Okay? So I think in the last few months, I think that's become accepted picture. But so that gold gives you the diversification. What some people didn't realize that gold is not the same everywhere. Right? You buy a gold fund here, you buy a gold ETF there. Is it exactly the same? It may not be exactly the same, right? I think the bigger gold ETF that we all know today, where is it custodized? Where is the gold custodized? It's in US and in UK. All right? And given what has actually been changing, and I think you know about what happened to Russia and all these issues, you may buy the gold fund today, it's custodized in the US and UK when you want it. And you use gold as an insurance. And that's the point when you need it most, you don't get it. So we came up with the idea, and which is what you mentioned about safe haven, right? Singapore, very strong governance structure, politically neutral, and so forth. So we feel that as an investor, besides just adding gold as part of your diversification, you have to also be concerned about how you buy your gold. Where that gold is kept is actually an important part, which again is your safe haven. So which is why we came out with a gold fund that is actually similar to a gold ETF that most people are familiar with, except that it's actually custodized in Singapore. And we believe that actually investors, right, if you have invested in gold, should you put all into one single ETF that is custodized out of US and UK? Or should you actually start to think about diversification and say, maybe I should take half and then put that in the Lion Global Gold Fund where it's custodized in Singapore? Because you talk about gold as a diversification, but people didn't realize that where you keep the gold is also another element that you need to think about. All right, so that's how we came up with the idea.
And you think like a lot of Singaporeans are aware of that important thing to think about?
I think those who are actually following the financial news and they see what is actually happening around the world, I think they will start to realize that. I think if you look around the world, the central banks, okay, some of them are starting to start talking about bringing back their gold. All right, I think you have read that a few European countries, they are all talking about their gold reserve. They want to bring it back to their home country. So if you follow the news quite closely and you think that gold is your insurance, make sure you buy the right insurance. You may have bought the insurance, but the insurance may not work when you need it most.
So I mean, the concept of Singapore as the safe haven, and eventually, like now, even thinking about where you store your gold and everything, did it ever occur to you when you were starting out in your career in finance and all that, we'd be at this stage where Singapore is seen as like, compared to other places in the world, other superpowers of the world, it could be a safer place to actually have your investments and store your gold like that. Like to me, it kind of blows my mind that what I'm watching the news today and then what Singapore represents to the rest of the world. But how is it for you as a finance professional?
Actually, truthfully, if you ask me 30 years ago, right, when we all look at Asia, we are looking at Asian tigers, high growth. We were not honestly looking at safe haven. I think this safe haven thing comes about maybe in the last few years, given the change in the geopolitical side. I think the old days when people come to Asia, they look at the four tigers. I don't know whether you still remember all this terminology. Korea, Taiwan, Singapore, Hong Kong, so they were all looking for growth.
I see.
But I think this safe haven thing came about. The world has actually, in a way, become a little bit more polarized. And there's a lot more what I would call populism and so forth. And governments are actually behaving slightly differently from the old days. So I think there's a need for a rethinking, how you want to protect your portfolio, whether what you think you are doing is the right thing. So I think that's something that investors will have to start thinking about it.
But like when you mention Singapore investors, like a product for Singapore investors, is there a flip side where, because Singapore is seen to be very safe, that investors also might take things for granted? For example, like I think one thing about growing up in Singapore, you think, okay, everything is safe, you can do this, there's no risk. So maybe that's also a reason why people think, oh, gold, as long as it's gold, it must be legit, it must be safe. Do you think that has a kind of like impact on Singapore investors, almost taking things too much like just on paper, like on the nose?
I don't think so. I think for those people who have been following the news, I think they will know, especially they look at what happened to Russia, right? So some people will start to rethink about and say, or even if they don't start to think about that, hopefully with this podcast, we can start to engage people and say, do you want to start thinking about that? Right?
And you mentioned like the gold that's custodized in Singapore. One thing that Lion Global is also launching is a Singapore Physical Gold ETF, right? I mean, maybe you can just help us understand also the difference between a gold and a gold ETF. Yeah, because I would think that I would understand the ETF tracks like a physical gold. So shouldn't the ups and downs also be similar?
Okay, so basically we launch a gold fund. This is what in Singapore context we call a UT, a unit trust. Now, the advantage, there are disadvantages and disadvantages of a unit trust, right? When you buy or you redeem, you only know the end of the day closing price. So intraday, the gold price may fluctuate, but actually when you go and buy right now, you only get the closing price at the end of the day, which may be slightly different from what you have today. Okay, but unit trust, again, some people like it because it has its other peculiarities, but also unit trusts tend to be actually sold via banks. And some people are more comfortable talking to a financial advisor and say, oh, help me to construct this portfolio, whether I should have this, I should have that. And that is actually one so-called avenue of, and I think that tend to be the older folks who are still more comfortable with getting a financial advisor to help them, and that's the unit trust route.
Yeah.
But with the younger people like you, both of you, you want to be self-directed. Nowadays, you all go to platforms, you want to be able to go and buy.
Yeah.
Okay, so which is why we are actually taking the same unit trust, listing it as an ETF. Essentially, the fund is the same. But in the ETF, you can buy intraday, and you are able to buy through the SGX, the stock exchange, rather than a gold UT where you only get the price at the end of the day. So our whole idea here is that we want to reach out to different investors. The older folks who tend to buy through financial advisor tend to go through unit trust, but the younger people, they buy all through platform, they are self-directed. So we want to reach out to these people.
I see.
At the end of the day, we feel that it's important that we reach out to more people and help them in their financial planning for retirement.
Because that means, because like what you said, previously without the ETF for those retail investment apps where you can buy stocks and all, you might not have access to gold. But with the ETF now, you can. Or it depends on the platform.
The retail investors can still buy unit trust. But again, they will have to buy through platform, and it's actually end of the day closing price.
Okay.
Some platforms actually, there's no front-end charge, but some platforms tend to have a front-end charge. So depending on your personality and how familiar you are with investments, some people prefer the unit trust route, some people prefer the ETF route.
I see.
Yeah, so actually for Lion Global, again, we have this same thinking, right? There are the younger people who want to self-directed and they want to buy through ETF. So in the last few years, we have actually been quite active launching new ETF. So they could be just a new ETF, or they could actually be from our unit trust and we list that unit trust. So actually it's one big fund, but you can buy both ways.
I see.
So actually we did that starting with our short duration bond fund. It's a Singapore fixed income fund. That was the first one. This gold ETF that we are doing is the second one that we are doing, in the sense that it's a UT and a ETF at the same time.
I mean, the message of like, you want to help Singaporeans fulfill their retirement dreams and all, but and at the same time also, because the gold is custodized in Singapore, it's different from gold that's custodized elsewhere. An ETF based on gold custodized in Singapore is different. That means it's kind of like requiring investors in Singapore to also be more aware of what's going on around the world, right? Does that affect how you talk to the people that work for you about their understanding? They have to understand what is really going on around the world. They're no longer just looking at numbers as well. They have to better understand everything that's going on in geopolitics and read up the news a lot more than what finance professionals like 20, 30 years ago might have had to do.
Actually, even if you are just a young fund manager, you will still have to read up a lot. I mean, a lot of our time is taken up reading, talking to companies and so forth. And to be in this business, I think you need to have a very interested or inquiring type of mind, where you read things here and there and you are able to connect the dots, and sometimes you're able to see implication of something that may or may not be so obvious. So I think that is important for a young person who wants to be in this industry. Whether I tell that to my people, I think honestly it's part and parcel. I expect them that they are all reading very widely.
How about the actual people on the ground, retail investors and all? Do you feel that they have a better sense of what's going on around the world than how it used to be before?
I think the younger people tend to be a little bit more knowledgeable in terms of what is happening around the world. And I think if you look at, there are various blogs, right? And some people are actually very good at all these things. I think if you remember 2 years ago when the T-bills were giving 3%, I know what a lot of people did, right? They took money from their CPF.
Put it in.
And then they put in there. And there are a lot of blogs that will tell you,
Yes.
okay, because CPF only pay you on your lowest balance for the month and so forth. How many days, what rate is the break-even rate and so forth. So a lot of people are very knowledgeable on all such things. Yeah, they're very savvy. Yeah. Sometimes they're even better than me. But what my greatest concern is that how many of these young people actually are thinking of building a portfolio that is actually suitable for their retirement 20, 30 years down the road? Or are these people just simply going in and say, okay, I buy, I make 10, 15%, I get out, without thinking in the longer term and say that I let it compound, but I invest in a portfolio that I'm comfortable with, that I can withstand the up and down over the next 10, 20 years. But with the compounding effect, then actually that will set you in very good state for your retirement. That is the concern that I have.
And what gives you that concern?
Okay, in my line of business, right? When people hear about, you work in Lion Global, first thing usually they ask you, what to buy?
We haven't asked you that yet. We haven't asked. We'll ask later.
And I will again do the same thing, right? I won't tell you exactly. And let me later explain to you why is that so. I'd rather the conversation start with, how do I build a portfolio for retirement? If you ask me what to buy, is it something that will make you 10, 15% and then you get out? To me, the whole conversation should be, how do you structure a portfolio that you want to keep for the next 10, 20 years? So one thing is basically that when you talk to people, nobody is actually engaging me on how to build a portfolio, right? I look at even my own kids, right? They were just buying here, there, but with no sense of, I need a balanced portfolio at this point in time. I'm younger, maybe I have 80% in equities, I have 20% in bonds, and then as the years go by, you start moving more to bonds and less to equities. I'm not quite sure even my own children, whether they have the sense of thinking about that.
Don't worry, we can clip this part and you can put in your family WhatsApp group.
But that's why I did want to ask you. There's a lot of young people who are self-informed and they're doing their own research and all that. Then what is the value of getting a financial advisor versus like doing it yourself? Because you mentioned older people go for financial advisors. But what is the actual value of getting a financial advisor?
Okay, if you have a good financial advisor, honestly, I think it can add a lot of value to you. Now, I look at it simplistically, right? Today, let's say you want to buy global equities, stocks. The broad index or the broad ETF, sometimes they come by MSCI World, the World Index. But a World Index, if you look at it carefully, 60% is in the US, with 20% somewhere maybe in Europe and so forth. But my main concern is that if it's 60% in the US, are you holding a diversified portfolio? Right? If the US market goes down or it doesn't do so well, that's 60% of your portfolio. Right? So if you have a good financial advisor and say, yes, of course, when we study, I don't know whether you study finance, they call it cap-and model, you should do market weight and so forth. But I like to look at more pragmatic and just a very simple basis. I say 60% in a single country is not diversification. All right. So if you have a financial advisor, you say, okay, why not we don't buy this broad index? You put some money in the US, you put some money in Asia, you put some money in Europe. And you make sure that you are really well diversified. So maybe a particular country or region is 1/3 of your portfolio. Your financial advisor can also be telling you, looking at your total wealth and so forth, what is the allocation that you should be, So I think there's value if you have a good financial advisor.
But going back to what you're saying about your concern is that people are not looking at it at the long term. Why do you think is that? Like, was that not the case 20, 30 years ago?
It's also the same 20, 30 years ago.
So
I mean, honestly, I have some colleagues,
nature.
right? So I asked one colleague, where do you keep all your savings? He said it's all cash.
Oh.
Yeah.
So no investment.
So there are some people who are actually still doing that.
But works in asset management.
But not the front line.
Oh, okay. But they interface with it every day.
So you think it's just more like tied to personality, human nature, experience? Because I'm sure this must be stuff you think about, right, when you want to communicate certain messages to your customers.
Actually, at this age, so-called during my life cycle, right, sometimes I think beyond what I'm doing. Actually, one of my hope is actually, how do I reach out to the masses? How do I actually communicate to them on the importance of actually building a portfolio that's suitable for you, that is actually relevant, and that actually something that will help you in your retirement. And my greatest fear is always that people don't understand and they just go in, and when you have, I don't know whether you all still remember 2022. We don't talk about 2008, the global financial crisis. That is actually quite long time ago, right? But you look at 2022, that was a year when the market is down about 20%. My greatest concern is whether when people actually, if they were unlucky enough to go in end 2021 and they suffer a 20% drop in 2022, how will they react? Is that something that they say, I will never touch stocks again because it's down 20%? So, and my advice to people is that if you have not bought stocks before and you have saved a lot of money, maybe 100,000 over the last 5-10 years, please don't put everything on day one. You may encounter 2022, nobody knows, right? I can't even predict what's going to happen to the market tomorrow, next 1 month, 3 months. When we look at something positive, it's usually a medium-term horizon, right?
Yeah.
So my advice to people is that learn how to dollar average. Buy a little bit, you need to put your foot in, because in the long term, stocks historically have shown that they can actually give better returns than cash. But if you have a very negative experience and you don't have what I would call the power to hold on, and you get nervous, actually that is always the worst time.
So then, does that kind of like give you assurance of, the recent announcement about the lifetime or life cycle retirement investment scheme? Does that, when you look at that, do you think it kind of fits with, addresses any concerns that you have?
Actually, I'm very happy to hear that announcement. I seriously felt that it's something that we should have done. I mean, of course, CPF 2.5% is very good. Right, risk-free is 2.5%. But if you look at the history of a portfolio, for example, and just I'll give you the example of the multi-asset portfolio that we started 7.5 years ago, right? Of course, we had the advantage the last 2-3 years markets have been good. But if we look at over 7.5 years, the return on the very conservative portfolio, which is 70% bonds, is about 4.6, 4.7. The higher risk portfolio, 70% equities, the annualized return is about 7.6, 7.7. Obviously, that has been much better than the 2.5 that you can get from CPF. But again, you must be able to ensure that you don't get COVID. Because while I can tell you over the size 7.5 years, yes, you make annualized 7% return in Sing dollar terms. But in 2022, there was a sharp market drop. If you do not have the holding power and then you get out at 2022 at the bottom of the cycle, then what will happen to you? So I want to go on a message and say that if you invest, do it cautiously. You need to invest. You need to have a portfolio, because in the longer term, that will still give you a better outcome than just simply cash. But you must do it in a manner that you're comfortable with, that you can stomach the volatility in the meantime.
But is that asking a lot of for a lot of discipline from the average person, right? Because sometimes I look at, when I say markets, I look at my Amazon cart and then the prices drop up and down. I was like, wow, I missed a good sale. So I can't imagine your portfolio, you drop 20%, then you're like, wow, I got to hold it in. I mean, how do you train up that kind of discipline?
Okay, when my portfolio dropped 20% in 2022, do I feel the pain? Of course I feel the pain.
What do you do to get past that emotion?
Okay. The way I tell myself is this, right? I still have another 10-15 years to retirement. I can afford to hold on. And history has actually shown me that if I can hold on to that, I may not recover back in the next 3 years, I don't know. But I'm quite confident that over 10-15 years, I can recover back. And luckily for me, 2023, 2024, 2025 were good years for the market. So it actually recovered very fast. But you must be mentally be prepared that sometimes it can take you 2-3 years or even 4-5 years before you recover.
I mean, it's heartening to know that even you felt it.
Of course, I felt the pain. Who don't feel the pain, right?
So your mood those few weeks were affected, or you managed to be stoic about it, lah?
Okay, actually in this industry, it's the double whammy, right? You have your own personal investments which are down.
Yeah.
And then you're managing money for your clients. And then when you go for client review, honestly, it's not very good to tell your client that, hey, you're down 5%, you're down 10%. But again, then that brings me to another philosophy, right? We do manage money for some institutions in Singapore, charity and so forth. And the philosophy that we have internally, and I told my people, is that don't chase the upside. Don't take extreme views. But in the downturn, try to protect as much as you can. You cannot fully protect. There's no way we can fully protect. But we must do it in such a way because you must understand psychology of the people. All right. Sometimes it's not whether in the long term you can go up, but if you have a drawdown that is very steep, people may not be able to take it. So our philosophy is that we don't want to take extreme views. You take extreme views, you are right, you are the hero, right? But if you are wrong, it's the client that is bearing the pain. Okay, so my philosophy, and again, that's the group philosophy, is that we don't chase, we don't take extreme views. We try to add value along the way, but we don't take extreme views.
Is it something you always have to fight, like the temptation to chase the next big thing, or the philosophy is ingrained, deep enough that everyone's on the same page?
I think the team that right now we have built up, I think they are all on the same page because they have gone through all this cycle with clients, right? And they know what the clients really want, especially the Singapore institutions. They tend to be a little bit more conservative. And we understand rightly, right? They are steward of that money, and the whole idea is to give you something better than cash. But it's not to chase the upside return. But in a downturn, you need to make sure that you protect them. So I'll rather be on the slightly conservative side. But obviously, at the end of the day, we have to add value to the client. Right? And over a cycle, I think their portfolios have definitely been better than if they just simply leave it in cash. Right? But whether if they have gone with someone that is more willing to be a high beta, what you call high beta manager, or taking higher risk views, they could have gotten better returns. But my thinking is that in 2022, for example, I think we have actually quite well protected our client. But of course, they lost money. But I think we have actually managed to protect the downside.
So, I mean, during gatherings or Chinese New Year and things like that, when people come and ask you about all these questions, especially young people, and they say, I'm willing to take risks and everything, right? Like, what do you think that they should be asking themselves about how they view risk? How should they think about their own risk appetite? Because, I mean, ultimately, you are giving the institutional expert that kind of advice. But for someone who's young and feels like they can take on more risk and all, like what do you ask them to think about?
Retirement.
Okay, I take a very simplistic view, and I think this is quite not uncommon in the industry, right? There's this thing what I call core portfolio and a satellite portfolio. So my core portfolio is this multi-asset portfolio that I have, right? Very diversified across regions, bonds, and equities. So that is my core for my retirement. Then sometimes you want to make life more interesting because, you hear something, you think, China could be interesting. Then do you put all your money into that just because you like the idea? You don't, because there's no certainty. And sometimes when the idea is so obvious, actually that's the worst. Sometimes when it's so obvious that this is going to go out, I always tell myself, no, cannot be, because if it's so obvious to me, it's obvious to everyone else. Right? So to me, there's no such thing as very obvious idea that it's going to go up. On hindsight, we can always say, it's so obvious. But it's not necessarily true. So if you want to take specific investments because you like certain things, right? I would say keep your core intact and you play your satellite. So for example, if you have $100, you make sure you keep the $80 there. $20, you exercise your views. Sometimes also make your life more interesting, right? If you just leave it down there, it's not so interesting. Then you say, oh, I make that right call. Oh, so good. And you feel good, right?
So there's that aspect of it. But you know, like, it feels like you manage risk very logically and all. In your personal life, are you like, when you're at dinners, are you also, whenever there's a new dish to try, do you think about, okay, should I, take the conservative route, or when it comes to things like food and all, you're a lot more, your risk appetite is different?
Okay, so the question is whether when you have a dish in front of you, do you take the food that you like best first, or you take it last?
So you think through that also, like?
No.
No, but you've been in finance for so long. Is there anything you've realized about the markets, about human nature, about psychology over the course of your 37-year career?
Yeah, it's too long.
Too long. But you've seen so much, and how has that shaped you as a person, or your philosophies or your perspectives on things like the markets, the economy, people?
Okay, throughout the cycle, right, I've gone past, and I think you all may not have seen it, the Asian financial crisis, 1997, then 2008, global financial crisis, right? And then you still have, along the ways, there are various things happening, right? Europe at one stage, 2014, I cannot remember. Also, there was some crisis in Europe and so forth. My advice is, be steady, don't be too greedy. And if something is very obvious, it not necessarily will pan out. Okay, sometimes when you come across the idea, you say, yeah, this look very true. I think it's very good. But to me, as I mentioned earlier, right, if it's so obvious and so good, a lot of people will have seen it. And there's this thing what we call market positioning, which means that everybody will have same idea, they will have gone in, they will have bought the thing. And then when the news come out, actually they may be selling to take profits. So you also have to be careful of positioning, be careful of market psychology, where you think other people are positioned. So when you look at investment, it's not just whether the fundamentals. Right? You also have to look at where people are positioned, because the fundamentals are there, but a lot of people also know about it. They could all well be positioned. And then it's a question of what is in the expectation. So the expectation, the company can continue to deliver, but the expectation is much higher, then actually the stock price may not move.
So, I mean, for the Line Global Singapore Physical Gold ETF, right? I mean, everyone's talking about gold now, because of what happened in the last 1-2 years. But, looking forward in the periods when maybe everything geopolitically is calmer and all, where does the gold ETF, how should it sit in your portfolio? What should you still think about it as?
Okay, I mentioned earlier, right, under what we call SAA, Strategic Asset Allocation. In the old days, our portfolio tend to be just equities and bonds. But if you are the more sophisticated private banks, they have private assets, real estate and private equity and so forth. But just look at the mainstream equities and bonds. I think in the last 1 year or so, it has become accepted that your SAA is not just equities and bonds, it's gold. So the question is actually, should you have 3%? Should you have 5%? Should you have 10% as gold as part of your overall asset allocation? When things become calmer, you may find that a lot of people who felt that actually, yes, it's calm at this point in time, but look at what has happened in the last few years. Maybe it's time for me to have that gold exposure, because actually, to be fair, gold has gone up a lot. So some people may not at this point in time feel that they want to have a full gold position. And I wouldn't advise it. Because if you don't have gold today, I would say, go and buy 2%, 3% for your portfolio, but don't go and buy 10% for your portfolio. So some of these people who may have actually gone in, who may have missed out, they may use the opportunity to top up again. Because you just actually don't know. Today, things can become, you won't know what is going to happen the next 1 year, 2 years, right? And if you look at the world today, honestly, are we going back to the globalization that we have seen in the last 10 years? I think the world is very polarized. There's a lot of populism everywhere. I think it's very difficult for the world to go back to where it was previously. So to me, gold will still be something that is part of your strategic asset allocation.
So even in your long career, everything you've seen, the world now feels different. It doesn't feel new, almost like uncharted territory for you.
Okay, to me, the world is always changing.
Yeah.
Right. I think if you look at when I started my career, okay, then you have the Asian tigers, you have the Asian financial crisis. There are always new things happening. All right, but what I can say maybe is that the last few years, there's a little bit more geopolitical risk that has actually come in, and that maybe investors will have to start to rethink, how they want to restructure their portfolio to take into account this geopolitical risk.
And I mean, like given that you're CEO of Lion Global Investors, and you mentioned before that there is this national interest, like you want to do good for Singaporeans, right? How does that kind of like is that something that you have to balance with other things that might pull you in different directions? And how core is that to the philosophy of the entity?
No, I think it doesn't run contrary to it, right? At the end of the day, we are trying to come out with a product that we feel is actually suitable and relevant for Singaporeans. Okay, so that is one part of it. Now, the other part, which is a little bit more personal to me, some people may call me nationalist or whatever, but I actually believe that everything else remaining the same, if I do something in this way, it will benefit the overall economy. In the end, it will also benefit me. So, for example, the gold thing, we pitch it to people more and say it's a diversification for you. You're buying gold for insurance. Make sure that when you want to activate the insurance, it's there, right? Because it's important in Singapore. But on my own internal thinking, the fact that the gold is voted in Singapore, which means that the value add, the safekeeping, the custodian, everything, the value add service is actually done in Singapore. In a way that adds to the overall vibrancy of the Singapore economy. And if we can, in a small way, make Singapore as a gold trading center and therefore bring more higher value added job to Singapore, to me, actually, that is a bonus. So that is actually part of my thinking. And actually, it's also part of my philosophy, right? We diverge now. Okay, when I go to FairPrice, not that I'm advertising for them, but I just shop at FairPrice, right? I tend to buy Singapore-grown vegetables, Singapore eggs.
Support local.
Yeah, I mean, honestly, I feel that we need to support them. And I'm lucky enough that I'm willing to offer to pay a slightly higher price for that. But I feel that if I can afford, I should support the local. Because at the end of the day, it's actually a whole local ecosystem, right? They are growing in Singapore. If the money is being spent here, actually you make the local economy more vibrant. But at the same time, it's actually more important that we can support them so that we can increase our food self-sufficiency. We'll never be able to be fully sufficient, right? But in some way can help that, I think we should do that. So, but that is more on a personal nature. So to me, one actually voted in Singapore, the Gold Fund is actually for diversification for people. And I really sincerely feel that that is something that people should look at. But on a more personal basis, I feel that by actually putting all these value-added service in Singapore, it can help to make the economy more vibrant, create more jobs for Singapore. That is really, really a big bonus for me.
I mean, the fact that you're coming on a Singapore podcast, you are supporting the podcast space also. So we appreciate you for doing this also.
But it's true. I mean, the idea of vaulting the gold in Singapore, the security of Singapore, of which, you do army, everything, you're part of that whole ecosystem also. And it makes me feel okay. At least
we had a part to play in the gold vault. Yeah,
we had
nice
a part to play
Terence.
in the safe haven that Singapore is. So, I mean, it does, there is the element of it
So
feels
Terence,
like
you
it's
can make
part
my 2.5 years worth it.
Yeah, exactly.
all of us.
That's why.
It's true.
Yeah. So I mean, looking forward, we've spoken about the new world order and all that, but what excites you about the space of, be it investing, be it the gold vault or things that LGI is doing, or even you personally?
Actually, to me, honestly, the next interesting thing, which is what we spoke about just now, right? The CPF, the life cycle investing. I honestly feel that is something that's good for Singaporean. And, you know, I'm actually quite interested to see how it evolve and how it develop. I mean, honestly, 2.5% is very good. Yeah, but if you have a long-term time horizon, 20, 30 years, I believe you can actually get an incremental return, 4%, 5%. But if I can educate enough of people on that, but make sure that they don't over-invest, make sure that they invest something that they are comfortable with, and therefore they can withstand the downturns. But in the longer term, they can actually achieve that 4, 5%. I would consider that as actually something that is a higher calling than rather than just investing money.
Wow. Awesome.
Okay,
cool.
that's cool.
Yeah, and I mean, very refreshing to hear like your thoughts personally also, like, because I can imagine definitely there'll be certain people who take the approach financial careers are just about making money. So it's nice to see that you have a broader philosophy.
I think about how it fits in Singapore.
Let me come back. When I started out in the job, it was just to make money. It's a job to make money.
We established.
We stay humble.
Stay humble. I'm sure that's a big part of what you do now. So, but you have an umbrella philosophy, which is good. Which is good to hear. So thanks so much for sharing. Now our final question is just another thing on the positive side. Your one Shiok Thing. So this is something that we can go first. So you have a couple of minutes to think of your answer. Terence, you have your one Shiok Thing?
Yes, I'm actually currently reading this book. It's called Think. Wait, let me just quickly pull up the name of the book because I have it as an ebook in my library app. It's not the usual, but it's basically I've been thinking a lot about how to. In this day and age where we talk about authenticity, right? Like, what does it mean to speak authentically? Like when someone asks you for your opinion at a dinner party, what does it mean to really be able to hold a conversation properly with that person? I mean, we do a podcast, but we understand there's a performative aspect to it. But when you're sitting at a dinner table, you want to be able to think faster and talk smarter. So that's the name of the book by Matt Abraham. So he teaches a lot of interesting techniques that you should use to, when you are asked a question that, you get nervous about people judging you on your answer because it has to be smart. There are certain very specific techniques that he teaches for you to be able to calm yourself down, think of how to add to the conversation and not be so self-conscious about it. So for example, there are certain techniques like he asks you to come up with an acronym that reminds you of of little things like don't say, oh, I feel so anxious about this. But in your mind, you should be thinking, oh, I feel excited to reply the message, things like that. And then they ask you to also think of a mantra for yourself of how to, cool down and just realize that, hey, your opinion does matter and you have something to add to the conversation. And also at the end to also breathe properly as you speak. That means try to finish your sentence at the exact point that you finish your breath. So naturally,
that's something I learned now.
So you time your speaking such that you actually finish your sentence at the end of your breath. So you take a breath and then you continue your next sentence. So the pauses come naturally and you just don't go So all these little things that even us as podcasters, 700 plus episodes, I never knew. I don't know. So I'm enjoying reading this book. Even after all this experience as a podcaster and understanding, hey, we can still make better conversations with people, Chinese New Year, Deepavali, whatever.
I see. Interesting. You read it ahead of Chinese New Year?
I'm in the midst of it now, but I'm finding it very engaging.
Okay. So my one Shiok Thing is a channel that actually Terence introduced me to recently, which, the title of the channel sounds a bit presumptuous. It's the Luxury Academy. But it's a channel where I'm not so sure the background of this person, but the host, he talks a lot about the psychology of, especially for companies or people who are selling services or selling products, just the psychology of pricing, what sort of value you're providing to customers. And it's less about, trying to rip them off, but it's really how to convince them of the value of anything that you bring or sell to them. So, and it's very short clips. It's like 3 minutes, 4 minutes. quite interesting. Like for example, want clients to trust you, do this, and it can be taken the wrong way, I guess, but there's actually a lot of good value there. Because it's not just talking to people with money or anything. It's just human psychology. It's very interesting.
Our one-shook thing is both about how to talk to people.
Right?
That's actually why we're feeling very insecure about this these days.
Okay, both of you are going to put me to shame. I think this morning, just before we started, we talked about one-shook thing. I was just thinking, what's the one-shook thing? And after hearing both of you, it's going to be very let down. My one-shook thing is just simply on the Sunday morning, take a relaxing breakfast with my wife. You know, the whole work week has been very hectic, very tiring. I just want to sit down, eat my nasi lemak, or eat my mee siam with my wife. That's all. That's the shook thing for me.
Is there a place that you always go to at one
where you get your nasi lemak from?
Or anything?
Okay, actually, I stay somewhere quite near Serangoon, right? So there is a next there where you can, there's quite a few breakfast places you can go. Sometimes I take my nasi lemak in next, or sometimes Singapore, you always take your kaya toast, your half-boiled egg, and your coffee.
Not Chom Chom, the area.
Chom Chom doesn't open in the morning. You only open in the evening.
I always forget that,
Okay, so it's a letdown compared to
no.
things that you mentioned, which is learning process. Mine is just filling my stomach.
But it helps you maybe relax and recalibrate your discipline for investing for the rest of the week.
And it's a local breakfast. So it's really support.
To me, it's always nasi lemak, mee siam, or your kaya toast with half-boiled egg.
The local ecosystem.
But the other part is also, of course, two of us, we are old. And then sometimes they look at me as quite stingy because we usually just order one set.
Then you share lah.
I don't know. At this age, I'm not quite sure whether I want to eat 2 half-boiled eggs or not. So usually just order one set.
Share the half-boiled eggs.
Balance the portfolio.
One person just take one egg.
Very balanced approach to everything in life. But thank you so much for joining us. Very, very informative, and all the best with whatever LGI is doing in future.
Thank you for having me here. Thank you very much.
So, Harsh, what do you think of that conversation with Joo Wah, man?
I enjoyed it, man. And I think as a person, because to be honest, when I knew the CEO of LGI was coming, I didn't know what to expect. He doesn't do too many interviews. And I can totally imagine if someone from an organization like that comes and it's really about, making the ROI. But to hear him talk about his own epiphany, the fact that there's a broader goal that he's trying to support, actually very, very personable.
Yeah, especially that point about the supporting local, I didn't think of it that way. It's not just about using Singapore as a safe haven, as a base, right? But it's about, if the gold is vaulted here, there needs to be an ecosystem around it, whether it's the security side of things and or just making sure that how is the gold even vaulted here and all that? There has to be an industry around it, right? So the fact that we are, the fund is looking at Singapore as the safe haven, and then because of that, we have to vault it here. We have to hire people to do all that stuff around it. That actually just, it makes the system more vibrant. And the fact that we are here on a Singapore podcast talking about it as well. There's just this whole, a lot of Singaporeans were involved in this process.
Exactly.
Kind of thing.
And I mean that belief that, people come here and we have this because we are a safe country. I mean, when you have a safe home, it feels like a good thing. You can provide for your family, and this one. And I mean, just the stuff he was talking about, he was quite open, just, sharing his own thought process, how he has changed over the years. And quite informative also in terms of the differences between ETF, unit trust and all that.
I thought the other interesting point was he said the idea of Singapore as a safe haven is actually a relatively new concept. And he brings him back to the days when we talk about Asian tigers and all that, which I do remember in my schooling days, where it was all about growth at all costs. Whereas the idea of Singapore almost like Switzerland kind of, that's actually a more recent concept, which I totally forgot that. At one point people were thinking of Singapore as exciting place, Bugis Street and all that kind of stuff. But now it's very much more like, it's a safe place to store your money, and you don't have to worry about things here.
Plus you say I look young.
Oh yeah, okay, that won it for you, basically.
Initially I was like, when he said that, I was like,
so now we know how easy it is to get your good books. No, but honestly, I also enjoyed listening to him talk about this. And when you ask me asset manager, I'm like, what? Like what do we talk about? But yeah, we talked about a lot more things than just about money. Right?
And he was a bit like, I mean, you can tell his podcasting is not his normal, format. But I thought he was great.
Yeah.
It was great. But I mean, his one Shiok Thing, I wish we have to hypothesize where he eats his nasi lemak. Maybe he don't want to say where lah. Maybe he don't want to say where.
Yeah. You don't want to everybody to swarm there one day.
But I mean, nasi lemak, kaya toast, even then is like, support local. Yeah, very wholesome. Very wholesome.
So it's a fun conversation.
Yeah, fun conversation. I mean, hopefully it was fun for you guys listening and watching. If you found it useful, it'd be great if you could share it with someone. If you want to see shorter excerpts, not just of this podcast, but every podcast, you can follow us on social media. So TikTok, Instagram, Reddit, and Telegram. And if you want a nice weekly email with all the one Shiok things from that week, you can sign up for Yalabat. Sign up for your little bit at yalabat.com.
And if you want to support local and work with us, email us at contact@ministryoffunny.com or just go to ministryoffunny.com, our website. You see what we do there, as well as a contact us page there.
Sweet. Thanks for listening, everybody, and we'll talk to you all soon.